Hello and welcome, everybody. SF Live episode 178. Happy Monday. Thanks for joining us in this new week. In a few short seconds, we'll be joined by Chris Temple. He's the editor and publisher of The National Investor, and we're going to talk about some very different topics this time. We're going to talk about inflation, stagflation, which is something we haven't talked about too much here on SF Live in the recent months, so that's going to be interesting. We're also going to talk, of course, gold, copper, silver, uranium, and see what the outlooks there are and how the supply and demand looks like. Also, Chris has got a special offer for our audience, so stay tuned for that. And we're also going to talk top stock picks, like what is Chris investing in, who does he like, what does he like right now as well. So stay tuned for that during the interview. He's going to make that known in public. Of course, don't forget to follow us on YouTube, follow us on Twitter. Don't forget to hit the like and subscribe button. Turn on that little bell notification as well. As we do all our interviews live, you do get a push notification on your screen, being it the phone or your browser, when we go live. So make sure to use that to your advantage and join us live here every time we go live. Also, this is an interactive format. Make sure to use the either YouTube chat, you can get your questions in, or the Twitter hashtag function. Use hashtag AskNI for a national investor. And we'll get to the questions either during the conversation with Chris or right after we've been through our conversation as well. So make sure to use that to your advantage, of course. Now, enough of me. Let me switch over to my guest. And it's great to welcome you, Chris. Good to see you. How are you doing?
Well, doing great. Long time, Kai. I'm glad to be with you. We're surviving down here in Florida.
I think the last time we saw each other was in New Orleans, 2018 in person or something like that. We haven't seen each other since,
that.
I think.
A couple, 3 years ago, yeah.
Crazy.
Yeah.
Time flies.
It does.
So,
it does.
No, it's good to see you. Of course, appreciate you coming on. You just put out a new issue, so we've got lots to talk about, a lot of fresh material, of course, to talk about. And you named the main article of your issue. Right, hold on. I'm getting ahead of myself. Getting way ahead of myself. This is the first time you're on SF Live. Let's introduce you properly before we dive right into the topic. Who's Chris Temple and what does the National Investor do?
Well, thank you. Look, I'll be quick. The National Investor is a newsletter I've published under that name since 1996, so it was a quarter of a century. And before that, for 10 years, I did one called Your Money Today. So though I started at the ripe old age, literally of 18 years old in the retail financial planning area, almost all of my adult life has been as a writer, commentator, speaker, and whatnot. And I try and make things understandable to people. The motto on my website is you can get information anywhere, but here you get knowledge. And I've tried to do two things for people. Number one is make the macro picture and the big picture, if you will, understandable, so it's not confusing to people. Very few people are able to do that. And secondly is to hopefully, before others find them, find emerging growth companies, find good story stocks, because you've got people that like to day trade, time the market, and do all that kind of thing. But over the decades, there has never been a better way for the average person who doesn't want to have to sit in front of their computer all day long to build wealth than to buy good companies when they're cheap, and hopefully when they're just starting out, nobody else knows about them. So those are the things that I do, Kai.
Fantastic. Perfect. We're going to touch on quite a few things, and let's start with the overall dropping knowledge on the macro environment. Let's talk about that. And I already gave it away a little bit earlier, but your latest issue talked about the Flation debate, inflation versus stagflation, or inflation with stagflation, or stagflation is part of inflation. I don't know how you want to phrase it, but run us through where are we in the current macro environment? Where are we sitting? What are we looking at? And what's your thesis on how we're moving forward?
Well, one of the things I've said, Kai, and in fact, the cover story of my new issue I've made available publicly. It's on the front page of my website, nationalinvestor.com. So we can't possibly cover all of it now, especially with other subjects. I'll encourage people to go there. But basically, the takeaway is this. How we measure inflation has changed from when I first got in this industry 40 years ago. Inflation used to be, now, first of all, like the late Milton Friedman said, inflation is always and everywhere a monetary phenomenon. So when the central bank prints lots of money, it's going to show up someplace. Once upon a time, when I was a teenager and getting into my adult years, that was measured primarily by goods and services. It is no longer measured that way. It is now starting with asset prices. So, for example, we have people today saying, oh, the Fed is keeping interest rates down. They're inviting hyperinflation. I don't know where people have been since, and we can go back to the end of the financial crisis in 2008, or more recently, even from the depths of everything plunging last spring, you've had hyperinflation, folks. You're just looking in the wrong place for it. Okay, it's in asset prices. It's in a real estate bubble again. It's in Bitcoin and all of the other cryptocurrencies. Wherever you want to look, we've had hyperinflation. And so the question now is how much and to what extent and for how long will that hyperinflation and those increased dollars bleed down or continue to bleed down into commodity prices, which a lot of which have been on a tear, and now, as we see more and more, into living costs, where even according to the BLS, which stands for the Bureau of Lying Statistics, even according to their skewed numbers, inflation is perking up more than it's been in years, and it's going to go on for a while. So we have to see. In my view, and this sounds very counterintuitive, the near-term danger of a shock is deflation, not inflation, because Jerome Powell, who, when he first took the job as Fed chairman, correctly berated the Fed he was now running for having caused the last two major financial and economic collapses by being too easy with money. Now he's done stuff that would make Alan Greenspan blush in the last year. So that's the danger that no one's looking at, because we're all worrying about a commodity super cycle and the inflation of the 1970s again and stuff. And it's not going to be that simple. This is going to hit a wall before people realize.
So to define that scenario for us, deflation, like what does that look like? Right now we're looking at everything like higher gas prices, price per gallon is up. Obviously lumbers, it seems to be the meme joke these days, because I see that on Twitter left, right, and center. Of course, there are other agricultural like assets and commodities that are going up, real estate prices, as you said. But what does deflation look like on the other side?
What deflation looks like, Kai, could be one of two things. It would probably start first with the financial market accident of some kind. We're fortunate that the recent implosion of that Archegos hedge fund, which cost Credit Suisse $5 billion plus alone, and before that, Robinhood almost imploding and taking a few other firms with it before the cavalry came and several billion was injected into Robinhood to keep them from falling apart. Hyperinflation of financial assets carries within it the seeds of the deflation. We saw that in 2007 and 8 when we had this ridiculous activity in mortgage and real estate markets. That caused a deflation as the opposite result of that. A smaller version of that we had for a while, another episode last spring, but then back in 2015 and 16, the same thing happened with the energy sector for a while, where a lot of recklessness with credit creation caused a lot of debt creation, companies, taking on way too much production capacity, that crashed. Now we've got the everything bubbling, and I don't pretend to know where it's going to happen, but I'm just telling you as a matter of simple mathematics, it is not open-ended. There's going to be something come along that the Fed will have to react to again, as they always do, that's going to cause all of a sudden this air pocket. The NASDAQ drops 20% when all of a sudden we get another big spike up in long-term interest rates in the markets, whatever it is. So that's the danger right now. Granted, the Fed is pushing back against that preemptively more than they've ever done to try and prevent it. And that's where the stagflation thing comes in. Because once the sugar high runs out from all the stimulus and people getting all of these checks to sit home on the rear end or buy Dogecoin or whatever they're doing with it, once that peters out, we're back to a dormant or stagnant economy, but with many trillions more of debt to service as a result. And as the Fed continues to print money to try and fight that, and the old saying for that is pushing on a string, that's where the stagflation will come in. Costs may continue to rise for a while, even as the economy itself slows down and the productive part of things slows down.
Well, stagflation also comes with high unemployment and stagnant demand, right? So we have seen, of course, lower demand due to COVID. Demand has slowed down, but it seems to be coming back. And just looking at what's happening in the U.S., it seems like it's way more advanced than other nations in terms of coming back online. High unemployment is also a number. It doesn't seem like that high right now. Of course, it's higher than it was because of COVID and the pandemic, but it seems like it's dropping. Like, how does that fit in?
Well, where it'll fit in is, and again, a lot of things are not going to be the same as they were in the 1970s. Forget about the unemployment statistics for a second, Kai, and look simply at what can the average person afford. Let's say you and I went out to dinner tonight and we put on a dog. We had the before dinner drinks, the after dinner drinks, dessert, and nice entree and stuff, and we're stuffed. And at the end of the night, the waiter brings a check, and we're looking at one another to see who's going to man up and grab the check, right? But before either of us does, the waiter says, "Gentlemen, listen. The chef wanted me to tell you that we've still got a lot of food in the kitchen. We don't want to let it go to waste. So you sit right there. The check's $200. You sit right there. We're going to repeat the entire thing from start to finish, everything you've had, but we'll only add $50 to the bill." Okay. I don't care if he takes $50 off the bill. I'm stuffed and you probably are too. And notwithstanding this spurt of part recovery and part stimulus, where there's been a lot of spending lately, that is still the lot of the average consumer, even here in America, where things are better than in a lot of places, and of the average business. There is not the ability to continue to go farther into debt and to buy stuff. Okay. And so that's where I think this is going to start to run into a wall. It's just what the cost of things is going to be. In the 1970s, when we had a multi-year run of what was called cost push inflation back then, a lot of things were different. You didn't have remotely the debt levels back then that you do today that makes taking on a lot more that difficult. You had employees a lot more capable back then of getting increases in wages regularly, not a one-shot thing, to keep up with the cost of living and so forth. Very little of that exists today. So again, my view is that we're going to have this inflation scare for a while. That's going to cause a couple rebellions in the bond market, which itself will be a governor, kind of like an escape valve or bleeder valve in a water boiler. But inevitably, I think that some of these people that think we're going back to a multi-year run of broadly rising prices and all of that implies it just defies mathematics. It can't happen.
So how are you protecting yourself? Like, how are you investing? How are you shifting your assets around to play the current scenario, right? Because cash will be obviously worth less. What are your
Yeah.
options?
I mean, up until now, like you and I were chatting earlier before we started recording, cash was a good place to be. It's still probably less bad than going too far over your skis and stuff that's way too expensive right now. But yeah, for the first time in a long time, you're going to be punished more by holding cash because living costs are going up at a faster rate than they have done. I think in the last several days, we've seen the CPI and PPI both at their hottest numbers in 8 or 10 years. And they're probably going to get higher still over the balance of the year before this all hits a wall. So cash, it still is not a bad idea. But part of the advice I'm giving people is that let's look around at the stuff that all of the Fed's money printing has not inflated yet. Everybody's been piling into a lot of the same stuff, the cryptocurrencies, the FANG stocks, the new Nifty 50, if you will, all of the usual suspects. What can we find out there that's got legitimate value? And as investors need to be choosier when they shop, as interest rates go up and costs go up, what's going to do even better, maybe, than it does right now when investors, because of the stagflation is coming, corporate earnings are going to get hit. I mean, I just told people this morning, one of my favorite retailers of all time is a North Carolina-based grocer named Ingles Markets. We've been in and out of that thing in different cycles for 20 years. We've more than doubled our money on it this go around. I've told people I've already taken one step toward the exit because they've had killer earnings for several quarters, and that's going to hit a wall. They're putting on a job fair right now, and they're going to have to pay a lot more to hopefully get enough employees to continue their expansion. And that's going to hit their bottom line. So stay away from stuff where the increases in commodity prices, be it food, be it metals, be it fuel, whatever, are not going to be as easy to pass on, and find stuff that's going to be insulated from that. I mean, I've got a lot of resource stocks on my list, but the stuff that is going to be in the resource area, the best fundamental setup and the least likelihood that a economic shock or harm elsewhere from inflation or anything is going to hurt it is the uranium story. And I've been saying that for quite a while. Aside from that, I love biotech stocks. I've had several home runs recently. A cancer-related one I just put on my list. It's already more than So look at the companies, maybe some of the better value stocks within healthcare, but you're going to have to pick and choose your spots. And again, find stuff that has not been picked over and where everybody hasn't rushed in because of all this money printing. Because the Fed, look, even if we get this deflation episode I'm talking about, and we will, it's only a question of when. I don't know exactly when because I can't find Doc Brown to borrow his DeLorean, but it's going to happen. But between now and then, what are the things that haven't been run up that much that long term are going to be good stories?
It's interesting. It's an interesting debate that boils down to is value versus growth, and you're suggesting value stocks, right? Because you're expecting growth stocks to run out of steam eventually. But when do you see that happening? Like, are we too early? Are we at the right time of the cycle? You're suggesting probably that we're in the right time of the cycle. So I'm curious, like, what your theory on that is.
I believe we are. We've seen that in fits and starts already in 2021. The NASDAQ is a perfect example. I didn't look at it for a few minutes before you and I were recording, but today, for example, the Dow was up 300 and some points, and the NASDAQ was down 60. The S&P and the Dow both have been adding to their all-time highs. The NASDAQ has had a heck of a difficult time, and I think that's going to continue. And the reason I am very bearish right now, in fact, I've got a short position as a hedge on one of the ETFs that shorts the NASDAQ, is because I am thoroughly convinced that this rise in market interest rates is not over. We're going to get another surge or two higher between now and the end of the year that's going to hit a lot of stuff. And the two top suspects that's going to hurt are going to be tech stocks and gold.
Interesting. Okay. It's going to hurt gold. I have to think about that. That penny drop while you were saying, okay, interesting. So you mentioned biotech stocks. Let's maybe start there. Like, why is that attractive for you right now?
You know, we've had, and it's been over the last 2 or 3 U.S. administrations, a different attitude at the Food and Drug Administration that is less bureaucratic. Not that it isn't at all, of course, but more inclined to err on the side of giving the public and patients of different diseases, especially ones that are unmet presently, hope for the future. So you've got a good regulatory backdrop, a good government backdrop, where generally speaking, the discovery is encouraged, research is encouraged, and it's rewarded. So whatever else happens of all the goofy stuff that's going on in our world, financially, politically, and otherwise, it is not stopping the progress of science. We have gone in recent years from better treatments to diseases to borderline cures. One I'll give you right now, a company called Cernova Corporation, very close to my heart, because just over a year ago, I lost a son to the long-term consequences of type 1 diabetes. This is a company that is closer than anybody else in human trials to what would essentially be a functional cure for type 1 diabetes. How big is that? That stock is up 5-fold since the end of last year. It's going to do way better than that if they're successful. So those are the kind of things that I can get my head around, that are close to me, that, again, it has nothing to do with inflation, stagflation, whatever flation. There's a lot of good, exciting stuff out there that a lot of people are ignoring, chasing these fantasies of the cryptocurrencies and whatever.
Biotech is actually quite close to mining, in my opinion. It's like it overlaps in terms of like you got to do studies, you got to go through the motions, you got to get the permits. So it's very similar. Like you have the bankable feasibility study sort of as your phase 3, I guess, clinical trials. Yeah. I would see that like as very similar comparison, right? And you mentioned actually
very
like
much.
Gold is actually going to be hurting when you say that tech stocks and gold are going to hurt. Like, what are some of your recommendations then? Do you see still within the gold space some opportunities?
I'll tell you, there's so many on my list, it's hard to know where to start. I probably have more individual gold stocks, or at least partially gold stocks, some with copper and other things as well. But gosh, I'll give you one up in Quebec, Amex Exploration, that has probably sold off recently more than a lot of other gold stocks have done. And I hate to single out one because there's a lot of them on my list, but it's way out of proportion to the incredible news that they have come out with recently. It's an advanced exploration company. This thing is worth way more than what it's selling for in the market. A recent addition, and Quebec Precious Metals, incidentally, up in that neighborhood, I like as well. They're a more speculative exploration company, but with much more upside than the average explorer has got. Let me just interject quick on that, since you brought up that subject, Kai, to give a little bit more red meat to our gold bugs out there. There are so many companies out there, I can't even keep track of them all. And one of the unfortunate things in the gold space, in my opinion, is that more of them didn't go away in the bear market, since we had for a lot of years after the peak in 2011. There's still way too many lifestyle companies out there, companies with just marginal deposits. Everybody and their brother's got a project that maybe is 800,000 ounces now, but if we do this and this and this and this, we can grow it to 1.1 million. So what? So can the 800 other companies. Okay, show me something more. So with the Quebec Precious Metals, and Amex for that matter, or in the U.S. here in the state of Nevada, another recent addition of mine is a company called Getchell Gold, where they have completely repurposed their Fondaway Canyon area. I'm a shareholder of it, actually of all three of these that I've mentioned. But Getchell has got a little over a million ounce resource now. And they don't have a game plan to grow this to 1.3 or 1.5. We could see even as early as this year erode to 3 to 5 million ounces. Look it up, folks. Some of the drill results they had last year, you don't see numbers like this in Nevada that often anymore. Okay. So there's a lot of companies on my list. Look, I am screamingly bullish long-term on gold. But twice last year, in February and around the 1st of August, I told people at those peaks to sell all of our trading positions. That is still my position because, like it or not, gold's fate is totally joined at the hip right now with the market level of interest rates. And if we get another surge higher in long-term interest rates, which I am thoroughly convinced we will, gold is still not a back up the truck place yet. We could still retest that recent 1675 an ounce low. So understand, and that's why I keep people isolated to individual stories where I'm willing to tolerate some near-term weakness. But, most recently last summer, we got out of our GDX, GDXJ, a few individual stocks I didn't want to stick with, and the UGL, the gold-centric ETF.
You mentioned a couple of other themes like uranium as well. Like, what else is like keeping your portfolio busy or yourself busy in the portfolio?
Well, I'll tell you, uranium again has got the best supply and demand setup of everything out there, hands down. The single best and most diverse company in that space is Energy Fuels, which is not only a uranium play, and specifically here, of course, in the U.S., as the government starts to have a little bit more concern about where our uranium comes from, thanks to the Trump administration and now Biden supporting this as well. We're going to have a strategic uranium reserve in the U.S., like we have a strategic petroleum reserve. But among other things, Energy Fuels recently has put the pieces together for a whole start to finish rare earth elements supply chain in the U.S. And that's a huge story, what a lot of people are still sleeping on. In fact, in just under 2 weeks, I'm making my trek north for the summer to spend time with my children and grandchildren in northern Wisconsin. On the way, I'll be visiting in western Tennessee with a company called Hyperion Metals, which owns the project that just did a deal with Energy Fuels to supply monazite to them as feedstock. And if anybody doesn't know what Hyperion Metals is, my biggest winner of 2020 was a company called Piedmont Lithium, which I was pounding the table on at $6 a share or so. They did their offtake deal with Tesla. Lithium heated up, and we went from $6 to 80 on Piedmont. The same management now has this project, this mineral sands project in western Tennessee that I'll be visiting. So a lot of good, exciting stuff out there.
Okay, interesting. I like that you're playing different themes and you're keeping an eye on the macro, but you're also more story focused when it comes to stock picking. So Fantastic. Chris, you mentioned you got a special offer for our audience as well.
Well, as far as a special offer is concerned, I mean, anybody could become a paid subscriber. And of course, that's the ultimate ulterior motive that I have. But it's the old puppy dog approach. If I give you something soft and cuddly and you really fall in love with it, then you don't want it taken away. You'll pay for it later. But before you get to that point, all you got to do is go to nationalinvestor.com and read a lot of the stuff I've got there. There's a place where you can sign up for my free mailing list. In the next few weeks, basically over the balance of the month of May, I'm putting out several special issues that I've been piecing together bit by bit. They're all coming out at once pretty much. One's going to be on the subject of Ecuador and the opportunities there. One's going to be a uranium-centric one. One is going to be an update of one I did last summer called This Is Not Your Father's Gold Market. Another one will be on the whole green energy and critical metals thing. And last but not least, there'll be one on just how to research and find story stocks, which is a great deal of fun for me, has been for years. And in fact, when you go to my website, it's a little bit dated, but there's a tutorial on there. It's a video that talks about how to find story stocks. They're under your nose every day, folks, but you don't realize it sometimes. This shows you how to find them.
We got a question here via YouTube. Quick question, like with U.S. With a new president in the White House, of course, or news relative nowadays, it's May. How do you see the mining sector develop in the U.S.?
Here's a problem. And again, on my website, you're going to see a very recent piece I put on there. I was one of about 200 people on a phone call or on a video conference, with Jennifer Granholm, who's President Biden's energy secretary, right after she was sworn in. So I was privileged to be on that call, first of all. And I'll tell you what, Jennifer Granholm, she has her act together. She's got a good game plan. Canadian by birth, for those that didn't know. So she's got some respect and understanding of the resource sector, number one. Number two, she was once the governor of Michigan, so she also has understanding of labor issues and industry and whatnot. And I'll tell you, if she was the final word, I would be delighted because I believe that the U.S. has the will somewhat to finally start to build within our own four walls. And a lot of this will be in partnership with Canada as well, of course. To have more localized supply chains for the green economy of the future, electric vehicles, and the whole thing. Problem is, as you will read there, that so far under the Biden administration, 3 major projects that had green lights now have yellow or red lights for them. One is the Thacker Pass lithium project in Nevada. The second is the Resolution Copper Mine, a joint venture between BHP and Rio Tinto in Arizona. And last but not least, a company that once upon a time was one of my top 10 winners of all time when I recommended this one before anybody heard of it, called Polymet Mining in the Arrowhead of Minnesota. And they now have got a renewed problem and the potential of the EPA pulling their water license. So out of nowhere, they wanted a new 90-day look back. And this company, which is the largest undeveloped but development stage polymetallic project on this continent, Kai, they have been going through this gauntlet for over 20 years of one nuisance suit after another of environmentalists and whatnot, and now a renewed question. So it's going to be interesting to see just how serious the Biden administration as a whole is, or are we going to continue to coddle the environmentalist fringe that thinks that Elon Musk has just got some magical extrusion machine that spits out Teslas? You don't need to mine anything. You don't need to produce anything. You don't need electricity. Boom, here they are. They're just like magic. So we'll see. But I'm cautiously optimistic over mining generally in the U.S., but it's not as easy a story as a lot of people want to believe.
I have no problems with jumping through some hoops to make sure it's all environmentally safe, but I don't like shifting of goalposts. That I'm not a big fan of that. So, Chris, I really appreciate you coming on the program. Really appreciate your insights, and it's been a while since we spoke, so it's long overdue that we caught up. Thanks for that, and thanks for extending the offer, of course, to our audience. Nationalinvestor.com, and you're also on Twitter at natinvestor, actually on Twitter.
Right.
So appreciate that. Everybody else, thanks for tuning in. Thanks for sending in your questions. Really appreciate that. It was SF Live episode 178. Don't forget to follow us on YouTube or at Twitter. Make sure to hit that like and subscribe button and turn on that bell notification as well. As you know, everything is live. And you have that advantage too, or you can use that advantage to your advantage when you hear about top stock picks or any other ideas as well, or hear straight from this CEO. Thanks so much for joining us. We'll be back at 12:30 Pacific with a breaking news special with GR Silver.